Taxes aren't pleasant to think about in a capitalistic society. There are dozens of types of taxes that make taxes pretty complicated for laypeople to understand. Different types of taxes can impact your income. Taxes on rental income is usually a subject of great debate during tax season. What type of income is rental income? Rental income is simply income earned from owning your property. Rental income includes rent payments, security deposits, and any other income a property owner accepts as a result of owning their property. You are supposed to include the rent you receive from a tenant in your gross income. 1. Advance rent. Any payment you accept from the tenant before payment is due is considered an advance payment. You are supposed to include any advance payments in your total income for the year in which you received them. For example, if you sign a 5-year lease and you received $3,000 worth of rent for the first year and $3,000 for the last year at the same time, you must include the total amount in the first year's rental income, $6,000. 2. Security deposits. There are different conditions in place for security deposits. If you intend to use the security deposit against any contingency in the lease, you must include it in your rental income. On the other hand, if you plan on returning the security deposit to the tenant towards the end of the lease, you shouldn't include it in your income. If you have to use the security deposit as the final rent payment, you'll also need to consider the payment as rental income and include it on your tax return. 3. Other expenses paid by tenant. Any funds your tenant spends on paying utility bills or on maintenance expenses also fall under rental income. You may deduct the amounts as expenses, but you have to include it in the first place. How to calculate the rental income tax. Rental income tax is treated similarly to federal income tax. If you fall within the 22% marginal tax rate, you're responsible for paying all applicable rental income tax. Here are some steps to follow to help with that. 1. Add up all payments you've received while it was occupied by a tenant over the year, be it security deposits, advance payments, or monthly rent. 2. Deduct all property expenses spent over the course of the year as we addressed above, i.e. depreciation, maintenance, etc. 3. The resulting amount is the total income to which you'll need to apply the 22% tax rate. Common rental income deductions. Multiple expenses can be deducted from rental income before taxes are applied. These deductions are effective in reducing income tax. Consider the following expenses as deductions to your gross rental income. 1. Mortgage interest. 2. Homeowner's insurance. 3. Repairs. 4. Maintenance and cleaning. 5. Utilities. 6. Homeowners association fees. Bear in mind that not all expenses related to your rental property can be deducted. If you are confused about whether or not an expense is deductible, consult a tax professional. Is rental income taxable? Few things in the world aren't taxable. Rental income is no exception because it's subject to taxation under the law just like any other income source. There are two types of rental businesses, passive and non-passive. Rental property is normally considered a passive business. Non-passive businesses include activities such as property development, operation, or management. Another factor that impacts rental taxation is the nature of the owner's involvement. If the owner manages the property, then the owner is an active participant, while if someone else manages the property, the owner is considered a non-active participant.